In this lesson, we will be looking at the different types of security trading. Specifically, we will be looking at equity trading, options trading, and trading in the over-the-counter market. The first type of security trading that we will discuss is trading equities. When we usually start a conversation with somebody about investing in stocks, we are more than likely referring to common shares or pieces of the company. Trading in the equities market is no different than trading in the stock market. In fact, they are synonymous. Each country has its own exchange. In the United States, the exchange is called the New York Stock Exchange. Similarly to how each country has its own exchange, each country also has its own trading hours. The New York Stock Exchange is open Monday through Friday from 9:30 a.m. to 4 p.m. Eastern Standard Time and is closed on weekends and national holidays. Here is a list of holidays when the market is closed. There are a total of 10 holidays that are observed and where the market is closed. It is important to note that if the observed holiday falls on a Saturday in a given year, the market will be closed on the Friday prior. Likewise, if the observed holiday falls on a Sunday, the market will be closed on the following Monday. So what is equity trading and how does it work? Equity trading is trading that involves simply buying and selling company shares or stock. Shares are portions of ownership of a publicly traded company. Shares are issued out by companies so that a company can raise money through investors. When you buy shares, you take direct ownership of that piece of the company, and when the price of that share increases in value, your share of the company also increases in value, allowing you to gain profit on your investment. Likewise, when that share decreases in value, your share of the company also decreases in value, resulting in you losing money on that investment. You can either invest directly into a single company, or you can invest into a collection of similar companies if you are more inclined to believe that an overall sector will do well. These collections of companies are called exchange-traded funds, or ETFs. In short, ETFs are baskets of securities. You can think of investing in ETFs like investing in a firm's portfolio. If their portfolio is doing well, that ETF's value will increase, leading to an increase in your investment. One of the most popular ETFs is the Standard & Poor's 500, also known as the S&P 500, which is a stock market index that tracks 500 companies in the United States. ETFs allow for a low-cost way for investors to diversify their portfolio in the stock market. When trading equities, return comes in two forms. It can come from growth, which as we mentioned earlier is when the value of a stock increases, resulting in the value of your portion being worth more, and it can also come in the form of dividend payouts, which is when companies distribute some of their profits to its shareholders. You can think of dividends as rewards from the company for simply owning their stock. The more shares you have, the more you receive from dividend payouts. Also, the more profitable a company is, the more the dividends will be worth. You can either receive these dividends in cash, where the payout is sent directly to your portfolio account, or you can have these payouts reinvested into the position, allowing you to grow your position size without having to put more money into the stock from your bankroll. So what are the different types of stocks that are considered equities? You have large cap stocks, which are also called blue chip stocks. Blue chip stocks are large companies, and these companies will tend to offer dividends as well as steady and consistent growth. Large cap stocks are generally the lowest risk when it comes to equities. There are also mid-cap stocks, which are medium-sized companies that can still pay out dividends. However, these companies are not as large nor as stable as blue chip stocks, which means that the investment is a little more risky. But what comes with more risk is a higher potential for growth. Likewise, a higher potential for loss. Finally, there are small cap stocks, which are small companies. These stocks are relatively high risk, but if a small cap company is successful, their stock price can go up drastically. So, what factors affect the price of an equity? You have internal factors, such as reports on how the company is doing. Each company releases an earnings report every quarter, and if those earnings are considered good by investors, the price of the stock may go up, and vice versa. If a company posts earnings that are considered poor by investors, then the price of the stock may decrease in value. There are also external factors, such as general economic conditions. If economic conditions across the market are good, then individual stocks will also tend to be doing well. But when economic conditions are poor, it is quite difficult for individual stocks to increase, and they tend to go down together. Also, the demand for shares of a company plays a large role in how the price of shares move. An increase in demand for shares of a company would raise the price of the stock since more people are willing to buy the shares at a higher price. Likewise, if demand for shares decreases, The stock will decrease as people are less willing to pay a higher premium for those shares, and people who are selling their shares will have to sell at a lower price since no one is willing to purchase the shares at the higher price. There are multiple ways in which you can approach equity trading. You can day trade, which is the act of buying and selling a position within the same day, where you are looking to profit off the momentum of quick moves on a stock. There is swing trading, which is quite similar to day trading, but you are holding the position for a couple of days to a couple of months, looking to catch the greater part of a move on an equity. And of course, there is long-term investing, which is simply just buying and holding a position with the conviction that the company will do well in the long run. Not only can you look to simply buy low and sell high, but you can also short equities, which is selling borrowed shares with the thought that the price of the stock will decrease. If the stock does decrease, you can repurchase those shares at the lower price to return to whom you borrowed them from originally, and you would then profit from the difference between the price you shorted at and the price that you repurchased the shares at. However, it is important to note that if the price of the stock increases, you will have to repurchase the shares for a higher price, resulting in you taking a loss on the position. With everything in the market, there are risks, and equity trading is no different. There are going to be some risks involved with equity trading. The obvious is that if the price of the stock makes adverse movements to your position, you will lose money, being that if you buy and the price goes down, the value of your investment will decrease. Likewise, if you short and the stock goes up, you will lose money as you will have to cover at a higher price than you shorted at. Another risk is the general conditions of the economy. If the economy is doing poorly, your stocks will also likely be doing poorly. However, you can combat this by diversifying your portfolio with a multitude of different assets outside of just equities. The second type of security trading that we will discuss is trading options. Options trading can sound a bit intimidating and overwhelming at first, but it isn't too difficult to understand once you get the hang of it. Options are derivatives that are being traded on the stock market today. Derivatives are contracts between two or more parties, and the value of these contracts is determined by a security or an asset. Option contracts' values fluctuate just like how the value of a stock fluctuates, but has a bit more of moving pieces, which we will discuss in greater detail later in this lesson. Anyway, the name of the game is to still buy low and to sell high. And the benefit to trading options is that the trader may have a higher potential for gain with less capital invested. However, one cannot hold a contract forever, as there are dates called expiration dates, which is when the contract expires. Usually, these dates are fixed on Fridays. Let's break down options for what they are. Essentially, they are contracts that give buyers the right to buy or sell an asset at a predetermined price or before the date of expiration. As we have just mentioned, they can assist a trader in maximizing gains and grow a smaller portfolio rather quickly. What comes with these potential increased gains is increased risk, which we will discuss after we get to know how options work a bit more. Options can take the form of calls or puts. You can think of options as like placing a side bet on the market. Buying a call option for a particular stock is like placing a side bet on that stock to perform well in a certain amount of time. Likewise, buying a put option is like placing a side bet on that stock to perform poorly in a certain amount of time. When you buy a call, if the asset increases past a certain amount before or by the expiration date, you profit. For puts, when you buy a put, if the asset decreases past a certain amount before or by the expiration date, you would profit. Why don't we break each of these down even further, starting with calls? Let's put a call option into terms of a real-world example. Imagine Apple offers you a contract where you can lock in the price for a new product that they have coming out in 5 years. They offer you a contract where you can lock in the price of the new product for just $200, since the expected price of this product is likely to be much more when it releases. This contract gives you the right to purchase this product for $200 if it is to be finished developing and released within the next 5 years. Meaning that after 5 years, this contract expires and you no longer have the right to lock in that price for the new product. Of course, a contract with this option would not be free, and Apple would charge a down payment so that you can have this option. Let's say that they charge a $50 down payment for you to have this option. This down payment, in terms of options contracts and financial markets, would be the premium that you pay for the contract. Now, say you purchase this option contract with Apple, and 4 years down the line, they release the new product and it is selling for a price of $1,000. Well, you still have the right to buy this new product for $200, so you exercise this right and receive the new product for only $200, where you can either keep the product or you can resell it for the going price of $1,000 and keep the difference as profit. Now, this does sound like quite a deal, but there are some risks that come with it. If the product does not come out in 5 years, but rather is released in 6 years, the contract would then have expired, no longer granting you the right to purchase the new product for $200. And if you would like to purchase the new product, you would have to pay the full price of $1,000. Also, even if the contract expired and you didn't exercise your right to buy, Apple would keep the down payment of $50, resulting in a $50 loss on your end. This concept of options call contracts can be applied to stocks and financial markets. Say you have conviction that stock XXX will increase in value by $100 over the next 6 months. What you can do to maximize your gains on this specific move is to buy a call option with an expiration date just over 6 months out and a strike price, which is the price that you think the stock will surpass, of $80 above the current price of the stock. When looking to buy an options contract, you will be able to select from a multitude of different strike prices depending on the price that you think the stock will surpass by that expiration date. One thing to note for calls is that the higher the strike price is, the cheaper the contract will cost you. Anyway, if you are correct about your conviction and the price of the stock increases by $100 within only 5 months, you have the right to exercise the contract, which allows you to buy the stock at the predetermined strike price, which in turn would result in you profiting the difference between the current price and the strike price, minus, of course, the premium that you paid. However, say your conviction is incorrect and the stock hardly moves over that 6 month period, or that move occurs in the opposite direction. Well, if you held the position to expiration, the price of the premium would then be worthless as the move did not occur as anticipated. You would then lose the premium that you paid since it would then be worthless, or if you were to sell the contract to another buyer before the expiration, the premium would be worth a lot less due to a couple factors that we will delve into a bit later. For now, let's move on to explain a put position. A put position is like the opposite of a call, where for a put, if the asset decreases past a certain price at or before the expiration, you would then profit. A real-world example of this would be home insurance. When you purchase home insurance, you pay a premium for a contract that allows you to pay a reduced cost to fix damages to your home if there are to be any before your insurance contract expires. If damages are to happen, your insurance would then cover the cost of damages. However, if nothing happens to your home before the insurance contract expires, you would still end up losing the premium that you paid for the insurance. This concept of options put contracts can be applied to financial markets as well. Say you fear the downside of stock XXX. Well, you can buy a put on that stock with such a strike price that if the stock drops below the strike price, you have already locked in the right to sell the stock at that certain price, which means that you would then profit the difference between the strike price and the lower price of the stock, minus, of course, the premium you paid to give you that right. If it doesn't end up dropping low enough to reach the strike price before expiration, you would lose the premium you paid and the right to sell the stock at the strike price as the contract would expire worthless. Now, there are 4 things that you can do with options. You can buy a call or put option, which we just mentioned previously, but you can also short sell the premium itself, where you would profit by the option contract premium decreasing in value. You would profit the maximum on short selling a call or put option by the stock not reaching the strike price by expiration, where you would profit the difference between the price that the premium was worth when you shorted it and the price of the premium at expiration. Similarly to buying a call or put option, you can close the position at any point before the expiration, regardless if the strike price has been reached or not. When short selling a premium, the position will be in the profit if the break-even point is not reached on the day of expiration. Likewise, if you are buying a premium, the position will be in profit if the break-even point is reached on the day of expiration. So how can we calculate break-even? To calculate the break-even point for calls, you simply add the premium price from when you open the position to the strike price, and that will give you the break-even price. For example, if you open a call position with a strike price of 100 for a premium of 6.35, the break-even point for that call would be 6.35 plus 100, which equals 106.35. To calculate the break-even point for puts, you simply take the strike price and subtract the premium from when you open the position to get your break-even point. For example, if you open a put position with a strike price of 100 for a premium of 8.50, the break-even point for that put would be 100 minus 8.50, which is equal to 91.50. So why buy options? There's two main reasons for playing options. The first being speculation. If you are speculative on a company's stock increasing or decreasing in value over a certain period of time, playing the option allows you to control greater quantities of the stock at a cheaper price. Buying call options or put options can be far cheaper than buying or selling the stock itself, allowing you to maximize your returns for a much cheaper investment. The second reason for playing options is in attempts to hedge a position, which is the purpose options were primarily invented to do. Hedging helps reduce overall risk of a position greatly as it acts as insurance in case there is to be an adverse move to what you anticipated. For example, say you are heavily invested in a tech stock, but you would like to limit your losses if a downside move is to occur. What you can do to hedge this possibility is buy puts so that even if the stock goes down, your put position would increase in value, reducing the loss on the overall investment. And remember, options allow you to control large positions for a much cheaper premium. So putting a small portion of your money relative to the position size in options can limit how much of a loss you can take if the stock you invested in is to move in the opposite direction from what you had in mind. Let's talk about some of the key factors that affect the premium of an options price so that we can better understand how they work. The more likely that something is to occur, the more expensive the premium will be for that particular option. Same thing goes for the opposite. The less likely that something is to occur, the less expensive that premium will be for that particular option. Another factor is the time till expiration. The more time there is till expiration, the more that contract will be worth, as time allows for greater probability of things happening. As time goes on, the price of the option premium will naturally decrease since the probability of that option being successful is decreasing if the stock has not moved. This concept is called time decay. And as time moves, time decay will eat away at the value of the contract until the expiration date, where if the strike price has not been reached, time would have eaten away the entire value of a contract. For example, an option contract that expires 1 year from now will have a higher premium than an option contract of the same strike price that expires 1 month from now. An option contract will also take on different values depending on the strike price. You have in the money strike prices, and you also have out of the money strike prices. In the money strike prices are strike prices that have already been reached by the current price of the stock. For example, if a stock is currently priced at $100 and we are looking at call options for that stock, in the money strike prices would be those strike prices below 100, being that these strike prices have already been exceeded by the price of the stock. Likewise, for puts for this same stock, in the money strike prices would be all strike prices above 100, being that if we are looking at the stock from the perception of a downside move, all of the strike prices above 100 would have already been surpassed. The deeper in the money a strike price, the more expensive it will cost to purchase that contract. Out of the money strike prices are strike prices that have not been reached by the current price of the stock. For example, using the same stock that we just mentioned that is currently priced at $100, for call options, all strike prices above 100 would be considered out of the money since they have not been reached yet. Likewise, for puts, all strike prices below 100 would be considered out of the money since they have not been achieved yet. The further out of the money a strike price is, the cheaper the premium of that contract will be. Another factor that plays into the price of an options premium is volatility. And this is due to the fact that uncertainty pushes the probability of outcomes in either direction higher. The higher the volatility a stock has, the more expensive the options premiums will be since the probability of a large move occurring is much higher, thus increasing the price of a premium. Also, it is important to note that option contracts are the option to buy or sell 100 shares. So when you are calculating the cost of a premium, you multiply the premium price by 100 to get the total cost that you will pay. For example, if a stock that is currently at $175 has a $200 strike price available for 2.15, this means that the premium you would pay is 2.15 times 100, which is $215. Now, as we have mentioned earlier, you do not need to hold onto an options contract until expiration. You can close the position at any point before the expiration date. This is actually what many traders will do in attempts to capitalize on the movements of option premium prices, which can move to one of the reasons previously mentioned. This is called premium flipping, where you buy an option premium for low and look to sell it when it increases in value due to the probability of that position being successful increasing without having to wait for the expiration for that contract to expire. For example, say we buy an option for a stock for a premium price of 2.00. The total cost of this position would be 2.00 times 100, which is $200. If the premium moved overnight to 2.50 due to the stock increasing by 2% overnight, the position would then be worth $250, and we can sell it right then and there for a $50 profit without having to wait until the expiration date. Capitalizing on that overnight move was the entirety of that trade, which resulted in a successful premium flip for that options contract. There are some increased risks when it comes to options, as when you are buying an option, you could lose the entirety of the money invested if that contract is to expire worthless. When you short an options premium, you take on a lot of risk as the potential loss can be nearly unlimited if the stock is to move in the opposite direction than you anticipated. For example, if you short a call option with a strike price of 100 and the underlying stock increases to 500, you would have to pay the entire difference in premium if you held that position all the way to 500 and it expired at that price. That difference in premium would be about $40,000 per options contract that you shorted, because 400, the movement of the stock itself, times 100 is equal to $40,000, which could be incredibly detrimental to a portfolio. Also, the closer you get to expiration, the quicker the premiums of options tend to move, which means the quicker a position can decrease in value. When playing options, it is important to understand the risks involved and to have a solid plan for when to close the position for both the stop loss and take profit. The last type of trading that we will be talking about in this lesson is trading in the over-the-counter market, or OTC trading. The over-the-counter market is a decentralized market where trading of assets occurs between two parties with no brokers. There are no physical locations where this trading is done, but rather it is all done electronically, where dealers act as the market makers as they quote prices on assets. The over-the-counter market is also far less transparent, with fewer regulations, as deals can happen without anyone knowing. The OTC market is primarily used to trade bonds, currencies, derivatives, and structured products, but this market is also widely used to trade penny stocks. In the OTC market, however, there are some risks, as there is limited liquidity due to the lack of buyers and sellers, so prices vary widely, making it quite dangerous for buyers who acquire large positions, as it can be hard for them to sell that position with a limited number of buyers on the market to sell to. There are also counterparty risks in the OTC market, which is when one party defaults before the completion of the trade and does not make current or future payments that are required by them in the contract. The lack of buyers also creates a risk for assets to be unreliably priced, since there are not enough transactions on the asset to get a true price. To illustrate these risks, imagine that a portfolio manager, a PM, owns 250,000 shares of a stock on the over-the-counter market. Well, this portfolio manager is looking to close out of this large position and sell, but when he tries to sell, the bid is set at $5 and the ask is set all the way at $42, creating a very wide range for what each share could be sold for. Also, there's only enough demand to sell 2,200 of these shares, making it incredibly difficult to sell all of the shares. What he can do is attempt to find buyers who would purchase it for cheaper than what it is listed for, or he can attempt to set limit orders in hopes that they will eventually sell. There were a couple terms in that example that we should go over so that you can fully grasp that situation. Specifically, we'll be looking at the bid and the ask, as well as what a limit order and a market order are. The bid essentially is the highest amount that the buyers are looking to pay for an asset or security, And the ask, on the other hand, is the lowest amount that sellers are looking to sell an asset or security. The difference between these two is called the bid-ask spread. When buying or selling in general, you typically want to aim for an entry or exit somewhere between the bid and the ask spread. The median between these two numbers is called the mid price, and that is typically where you are looking to pay for an asset or security. For example, a stock XXX has a bid price of 110 and an ask price of 120. The bid ask spread would then be $10 since 120 minus 110 is equal to 10, and the mid price would be 115, which is the price you would look to aim for to either buy or sell that stock. Now, there are two ways in which you can buy or sell an asset or security, through a limit order or a market order. You can set a limit order, which means that your order will only fill if the limit on that order is reached. For example, if you are trying to buy a stock for $44 and you set a limit order for $44, the purchase will only fill if someone sells it to you for $44 or less. Likewise, if you are looking to sell a stock for, say, $60 and you set a limit order for $60, the order will only sell if someone buys it from you for $60 or higher. The other way in which you can buy or sell an asset or security is through a market order. What a market order does is immediately fill your order so it buys or sells immediately. Typically, when you buy for a market order, it will fill your order at around the ask price. Likewise, if you are looking to sell with a market order, the order will fill around the bid price. For example, if a stock has a bid of $40 and an ask of $45, well, the mid price would be about $42.5, and if someone set a market order to purchase that stock, it would fill at about $45. Likewise, if someone set a market order to sell that same stock that had a bid of $40 and an ask of $45, it would fill at about $40. The reason for a market order is so that the order fills immediately, while in a limit order, it will not fill unless a certain price is reached. To recap, in this lesson, we went over 3 different types of security trading, including equity trading, options trading, and trading in over-the-counter markets. We also outlined the potential risks involved in these different types of trading, as well as some key terms for executing positions, such as the bid and ask spread, and the difference between a limit and market order. Before entering a position, it is paramount that you understand the risks involved. Anyway, that is all for this lesson on the different types of stock trading. In the next lesson, we will be going over how to execute a position from your mobile phone.